there's one piece of accounting jargon that trips people up the most, it must be debits and credits. What exactly does it mean to debit or credit an account? Why does debiting some accounts make it go up and others make it go down? Why is any of this even important for your business? In this video, I'll explain how it all works. If you haven't subscribed yet, do make sure you subscribe and turn on the bell so you know next time I upload a video about all things business money. My name is Annette Ferguson. I am a chartered accountant and certified profit first professional, and I run Annette Co, a UK-based accounting firm. So what are debits and credits? Well, in a nutshell, a debit records the money that flows into an account, and a credit records the money that flows out of an account. But what does that actually mean? For robust financial management, businesses use a system of bookkeeping called double entry bookkeeping. Under this system, the entire business finances are organized into individual accounts, like individual buckets representing each part of the spending in the business. So, for example, you have one bucket that represents the business bank accounts, and another that represents the total value of all the, say, furniture that you have in your business. And another bucket might represent a bank loan that you have recently taken out. And when your business does anything, whether that's buying a furniture or spending on research and development, then the amount in these buckets changes. If we had to write out every time when a business transaction took place, that would be incredibly tedious. So this is where debits and credits come in. It makes it easier to record the in and the out in the business. When money flows into a bucket, we call it a debit, and when money flows out of a bucket, we call it a credit. So for example, let's say that you deposit £300 into your business, and you're doing that into your business bank account. So we would mark that as debiting cash, £300. Now let's say that you withdraw £600 from the bank account. In that instance, we'd say that you are crediting £600. So we credit 600 cash. But there's one part that's missing, because money just doesn't suddenly appear or disappear. It has to come from somewhere and go to somewhere. And that's where the double entry comes in, both sides of a transaction. And every transaction, every financial transaction in your business has two sides to it, a debit side and a credit side. So let's say that you decide to purchase that standing desk that you've been eyeing up for months. And let's assume that this standing desk is £600. So what you need to do is you need to take the money out of your business bank account and spend it on the piece of furniture. So that means we need to take the £600 out of your cash bucket. And because the money is flowing out of your cash bucket, that means we credit your cash. And the other side of that is our furniture bucket. So we debit our furniture bucket by the same amount. So that is the double entry, the cash and the furniture. And those amounts need to equal each other to what we call balance. So debit, furniture 600, credit, bank 600. If this video is resonating with you so far, please do make sure you hit that like button. So what we've looked at so far is debits and credits in relation to asset accounts in the balance sheet, the bank account, the cash, and also the furniture account, which is a tangible fixed asset account in your balance sheet. How does it work when it comes to the liabilities part of your balance sheet and of your business? So let's assume that you now decide that you want to take out a small bank loan in your business. So you take out a bank loan for £100 and you increase the cash in your business. That of course means that you debit your cash bank account. So here's where it gets a little bit tricky, because you have increased cash, but you're also increasing the loan amount in your business. But remember, a loan is a liability. So in increasing the bank loan bucket, you're increasing the amount you owe. And the more you owe, the larger the number in the bank loan bucket will be. So in this case, we credit the bank loan bucket, and in crediting the bank loan, the number in that bucket gets greater. And that is because this bucket keeps track of the debt. So how we would record that is debiting cash 1,000, crediting bank loan 1,000. And debits and credits are also used to affect the profit and loss account. So for example, when you make a sale, you debit the bank and you credit the sales account. And when you pay expenses, you credit the bank and debit the expenses in the profit and loss account. So if you want to have a cheat sheet of what debit means in certain situations and credit means in certain situations, here it is. Now a credit decreases an asset account and decreases an expense account. It also increases a liability account and increases an equity account. It increases revenue, is always recorded on the right, and is shortened to the abbreviation CR. Now I get it. When I first started learning about debits and credits, my head was a bit blown away, and it, in all honesty, took me ages to actually figure out the debit and credit thing. But the more you look at it and the more you work with it, the easier and more natural it becomes to understand. And if you're struggling with the accounting for your business, I would love to support you. Do reach out by emailing me at yt@annetteco.co.uk. Thank you so much for watching. Make sure you hit that like button, subscribe, and I'll see you in the next video.